Okay, we're going to conclude our videos on stock valuation, and we'll explore some variations, if you will, of some previously discussed techniques and models. So the first one we're going to talk about is something called a variable growth model. Sometimes it's just referred to as a supernormal growth model. And the idea here is that there are some companies that, especially those companies that have very active research and development types of components, will have spurts of growth. They will invent something new, and they will have much higher growth in earnings because of that for a short period of time. Then eventually they will return back to the average growth rate of the industry. So this company has a new toothpaste, doesn't require a toothbrush. They expect some increase in earnings for a short period of time until corporate saboteurs steal the process. So for the next 3 years, they think earnings will grow at 15% and eventually go back to the industry average of 8%. Most current dividend was $2. The required return for the stock's 12%. And the company has been selling most recently at $61.75. So there is a model that's referred to as the supernormal stock valuation model. And essentially we need to plug in our details, right? The yellow boxes here is the data area. On the right-hand side are the calculations. So simply what happens here is this model, this spreadsheet, will forecast the next 3 years' dividends for the super growth period. It then calculates the present value of those. So this is the present value of the 3 years of future dividends. If you add those together, it's $6.33. It also then predicts a price at the end of this third period and finds the present value of that price. So then it adds the present value of these 3 dividends to the present value of the stock at the end of the supernormal growth period, and we have a forecast that this stock is roughly worth $64.78. The stock is currently selling for $61.75, so this would be a good stock to invest in. There are other approaches, though. And these other approaches utilize different techniques, different concepts, if you will. But in general, they assume that there is a relationship, much as we've been talking about dividends and value. We also know that there are other variables that have a relationship to value. One of which is something called free cash flow. Again, this is the cash flow that's available for the shareholders of the company and its other investors, including creditors. So it doesn't matter whether it pays out dividends or not. So this free cash flow model is actually a very good model, especially if the company doesn't pay dividends. We've talked about the PE approach, and these are what we refer to as multiplier models. So we'll discuss this in terms of some other forms of the PE approach. So in the major advantages is that these don't rely on dividends. So we don't have to have a dividend paying company in order to determine value. So the free cash flow to equity model, we just want to, again, estimate the cash flow that's available for shareholders and creditors after all the bills of the company have been paid. So our very basic formula for free cash flow is its net income plus depreciation plus the working capital investment net for the year, and also the net fixed asset investment for the year. The value of the company is then the present value of these future cash flows divided by the shares outstanding. So we'll develop this model as we go along. So we're going to need to forecast cash flow moving forward. similar to the dividend model, except now instead of looking at dividends, we're looking at cash flows. And there are three basic models we can use. They're the exact same models, except now we're substituting free cash flow for dividends. We could also use the internal rate of return concept to solve for expected returns. So we can use a trial and error method to try to find a discount rate that's going to help us determine the current value of the stock based on its free cash flows. And again, we're not going to get into a lot of detail about how that's actually used or how it's actually forecasted. We can also use the weighted average cost of capital of the company, which is the return that's required by investors for them to give us money. So there's several methods for us to determine the actual expected return using this free cash flow model. In essence, the value of the company is the sum of the value of the components of the financing. And if we do a little bit of algebra, the value of the stock of the company equals the value of the company minus the value of the dividends minus the value of the preferred stock. Again, it's a very simple model. One of the differences between this model and the dividend model is the dividend model creates an answer that's in per share. We initially start with a value here of the company of an answer that's in dollars. So we know what the total value of the stock of the company is. So we have this company, we've gathered some data for it. Let's look at, we know what the cash flows have been historically. The weighted average cost of capital for this company, that's the cost of financing, is 9%. And again, we can find this for a company. There's a website that's called That's WACC, right? That's THATSWACC.com. If you plug in your company's ticker symbol, it will give you a forecast of your company's cost of capital. We have an estimate of future growth rate of future cash flows or free cash flows. We know what the amount of debt is for the company, what the cash of the company is, and what the outstanding shares are. So now we have a worksheet, and I didn't put a label here, but it's the stock valuation free cash flow model, and we plug our numbers in, right? So here are all the numbers we have. The growth rate that we've estimated here has been about 10.67%. Right? The weighted average cost of capital is 9%, right? We're actually using a lower growth rate. We're saying that we think the growth is only going to be 3%. So next year's free cash flow is the $600,000 plus 3%. So the value of the corporation is $10,300,000. So that's what we think the company is worth if you just buy the stock in whole. So what then is, that's what the whole company is worth. We then need to incorporate debt and, in this case, also any cash to recognize what is the actual market value of the common stock, right? So you take 10.3, subtract out 3.5, subtract out this 750,000. So the market value of this stock is roughly 7.55 million. It has 300,000 shares. So this stock has an estimated value of $25.17. And again, this model is especially good if the company doesn't have shares, right? If the company doesn't have shares, we won't get a value per share, but you will know what the value of the equity of the company is, right? What is the ownership of this company worth? In this case, you would not want to pay more than $7.55 million to buy this company. That's what its value is of the ownership of the company. Moving on to some other techniques and kind of finishing up here, there is a whole series of what are referred to as multiplier models. There is a spreadsheet that's available for my class that's called Stock Valuation Multiplier Models. And you can utilize find the information that it asks for the different techniques, plug it in, and you will get a forecast of pricing. Again, the general idea is that there is a relationship between these variables and the price of the stock. So we have price to cash flow, price to sales, and price to book value. So if you can predict cash flow, sales, and book value, then you have a method here, or a technique, if you will, that you can predict price. So as we look at the basic ideas here, here's the price to cash flow ratio. Take the price divided by cash flow. If you want to estimate the price, right, solve for price. The price to cash flow ratio multiplied by your forecasted cash flow per share will give you a price number. And again, we have to identify what's the right number to use, right? What cash flow number is important. But maybe all three of these would give us a picture of what the value of the company should be, right? So there's lots of components, or lots of variation, if you will, of these different multiplier models. The price to book value ratio is a ratio we've looked up frequently, right? So we understand if we can predict book value, we can compare it to the price to book value ratio. Same thing with price to sales. So there is a worksheet model. It's called Stock Valuation Worksheet Model. In this case, I have three of these models here. Here's the PE multiplier, price to cash flow. Now, we just need to what? You need to estimate cash flow. The price to cash flow ratio, the PE ratio, and the company's price to sales ratio, these numbers are all published. So if you can forecast, right? If you can forecast out, then you can, if you can forecast the ratio, right? Cash flow, earnings per share, or sales, then you can calculate the value of the stock. So again, we get three valuations, if you will, of these companies' value. I particularly like these because they seem to give answers that at least verify the validity of the current price, right? The number that you get probably will not be substantially different. Now this number here, this ratio was just made up, right? So it really doesn't relate to an actual company. But we can find these multipliers that can give us some clues, at least in the short term, where you think the stock price will go. So that's the end of the videos on stock valuation.